What's going on, guys? It's Andy here. Welcome back to the Andy Kandola Show. So in today's video, I want to go ahead and start a new series on this channel. And basically what we're going to go ahead and do is we're going to review a couple different portfolios. Now, if you are new to my channel, basically in regards to this channel, I go ahead and focus on different portfolios. I have a dividend-based portfolio, which I call my bucket list portfolio. And in this portfolio, I focus on passive income. Basically, I want to go ahead and build this portfolio where I have enough dividends coming in so I can retire early, or at that point, I can just have my dividends basically pay for all my expenses. Now we'll go ahead and run through my portfolio as well in this video. And additionally, I want to go ahead and share with you guys a couple different portfolios that were sent over to me in regards to reviewing those portfolios and just giving my insight if that was my portfolio. So if you are interested in this type of review and you want me to go ahead and share my insight in regards to your portfolio, I will have my email in the description down below. If you want to go ahead and email me over your portfolio, and basically what I'm planning on doing here is reviewing multiple portfolios and choosing a couple portfolios and reviewing this on a monthly basis right now. And as I get more portfolios coming in, I might change my strategy and actually review this more or less according to if you guys like to see these type of videos. So let me know in the comments below if you guys like this type of content, and if you do want me to go ahead and review your portfolio, make sure to go ahead and email me that over along with a quick description of what your goals are with your portfolio so I can give you guys my insight and my feedback around that. But let's go ahead and jump into the video. Now my current portfolio is sitting at $42,285. Now in the last day here, my portfolio is up $175, and basically it's up 0.42%. Now if we look at the last week here, this portfolio is up $28 or 0.07%. If we look at the last month, the portfolio is down. It's down $1,655 or 4.10%. And if we look at the last quarter here, the portfolio is up $2,011.45 or about 8%. And all time the portfolio is up the same amount because this portfolio I started about 4 months ago. Now additionally, if we look here, the earned dividends in my portfolio so far this year have been $199. Now this is all coming from just the last quarter, and since I started this portfolio in the last quarter, I have been investing in this portfolio pretty heavily. My strategy has been to invest anywhere between $600 to $1,000 on a weekly basis. I am probably going to change the strategy at a later point, but right now I am going a bit aggressive in this portfolio because the market has still been down due to the pandemic. Now additionally, I do want to share with you guys some of the dividends in my portfolio and a couple stocks that I'm actually investing in right now. Now I have made a couple different changes in this portfolio, and basically as you guys can tell, I use M1 Finance. M1 Finance is a great app if you're focused on dividend investing, because what you can do is you can create different sectors within M1 Finance, and then you can go ahead and allocate a certain percentage that you want allocated to each one of these sectors so you can go ahead and diversify accordingly. Now what I've done is I've actually changed some of my allocations in my portfolio, and I will actually leave a link down in the description if you guys want to see all the stocks in my portfolio. I believe I have right around 67 stocks right now in my portfolio, but I did change as far as my target allocations in some of these sectors, so you can go ahead and check that out in the link down below. Now additionally, I am buying a couple stocks right now, and as of the trades this morning, I'm actually investing a little bit more in my tech sector because I actually changed my allocation on my technology sector. It was weighed into my portfolio at 16%, but I went ahead and changed it to 18%. So two of the stocks within my tech sector is Nvidia and Apple. Both of these stocks do pay a dividend. So these are the two stocks that I'm currently investing in right now. Now additionally, if we go ahead and look at the dividends in my portfolio, the dividends that I got paid in the last couple days here is from Merck and Company for $4.10, from Telus for $5.66, from Kimberly-Clark for $1.38, and from PPL Corporation for $9.71. And I believe Nike, I'm not sure if I brought this up in my last video, but Nike for 46 cents. So these are basically going to be some of the dividends that I just got paid recently. As you can tell, the dividends are starting to grow in this portfolio, and basically at this point I'm starting to see dividends basically on every single day in this portfolio. But guys, let's go ahead and jump into the main topic of this video, and let's go ahead and look at a couple different portfolios and basically some of the options and some of my feedback if this was my portfolio. And now the first portfolio that I want to go ahead and share with you guys is from Steve. Now just to share the email from Steve mentions that, hey, my name is Steve and I've enjoyed watching your videos. I'm a 34-year-old who is dollar cost averaging as much as I can monthly into this portfolio. The goal is to retire early, around 55, if not sooner. Anyways, we seem to have a pretty similar approach here, so I'd like to get your thoughts on my portfolio. So thanks for sending your portfolio over, Steve. And Steve, just so you know, you are one of my first portfolios that I am reviewing on this channel. So I will go ahead and share my insight in regards to your portfolio. But a couple things that I did want to point out that you're basically looking at in your objective here. So you're basically looking to retire in about 20 years from now. You are dollar cost averaging into this portfolio, similar to what I'm doing. So hey man, that's awesome, because dollar cost averaging is one of the best ways that I like to invest in my portfolio, because I don't have to look at the actual market value of a particular stock, whether the stock goes up or down. I'm focused on dividend investing, and that's exactly what you're saying here is your strategy as well. Now, in regards to your portfolio, I'm going to go ahead and pull that up here, then let's go ahead and run through that. Now, the first couple things that I'm going to go ahead and look at here, Steve, is your overall growth in your portfolio. Now, in regards to the 1-year returns in your portfolio, it looks like in 1 year you would have lost around 11% in performance. Now, as far as a 5-year growth performance, it looks like it'd be down about 3%. Now, I'm not so concerned with this, because as far as the performance goes of some of these stocks, because the market has been down, I can see why the performance of this portfolio overall will be down. Now, normally, just my overall take, I do try to weigh performance along with dividends pretty equally in the portfolio, because I do want to see a growth in my portfolio where I don't want the portfolio value to just stay at the same level. So for example, if your portfolio, and if you had invested $10,000 in this portfolio, you would have seen a 3% decrease over 5 years. And normally, just looking at this without digging too much into it yet, is I would go ahead and maybe look at some of these stocks that are just not going to be growing, or some of these stocks that when you're looking at their 5-year trends and their 5-year performance, go ahead and look at weighing a little bit less on some of those stocks and focus maybe a little bit more on growth, because you do have a 20-year goal. So I want to go ahead and see you grow your portfolio and build additional value. At the same time, you're going to go ahead and build dividends. Now, additionally, if we look at some of the holdings that you have 52 holdings in this portfolio, which is fair. I mean, like I said, I have about 67 holdings in my portfolio. Now, additionally, what I'm seeing here is a dividend yield of 5.33%. That's amazing, man. That's really good. 5.33% is actually a really solid dividend yield. Now, my portfolio is currently yielding right around 3.5%. So when I see this, hence, this is probably the reason why your performance in your portfolio is a little bit less, but your dividend is a lot higher. Now, because you're not looking to retire right now or in the next 5 or 10 years, that's why I'm saying to go ahead and maybe weigh a little bit more on the performance, and maybe you can reduce that dividend yield to right around 4%, but you'll see your performance go higher. And I do see that you have an expense ratio which is of 0.01%, so that does tell me that you might have ETFs. But now, just running through the slices, you basically have the portfolio broken up into 9 different slices. So we'll go ahead and run through each of these slices and look at the different stocks that you have. But let's go ahead and start off with industrials. Now, in regards to the industrial space, looks like you have 7 stocks and your dividend yield is 4.7%. That's an awesome dividend yield. Now, some of these stocks that you have in here is Waste Management, CC, International Papers, 3M, Raytheon Technologies, Delta Airlines, and Cleveland Cliff. Now, some of these companies I'm familiar with, and some of them I'm not as familiar with. But basically, as far as Waste Management goes, hands down, love this stock. This is actually one that I have in my portfolio. Additionally, 3M and International Paper, hands down, I also love these stocks, man. These are some of the best stocks within the industrial sector. Now, one that I would be a little concerned with would be a Delta Airlines. Now, Delta Airlines is a stock that's actually taken a huge hit because of this pandemic pandemic, less people are actually traveling as far as taking airlines. So I would just be a little cautious in regards to Delta Airlines. Cleveland Cliff, I'm not as familiar with this. I believe this is a mining company. And as far as Cleveland Cliff goes, let's go ahead and take a quick look at that. And now something that I usually like to look at is the dividend yield, which at this point is 4.66%. And also I like to go ahead and look at the 1-year performance and the 5-year performance. So if we look at the 5-year performance, the stock looks like it is up about 11%, but overall, if we look at the 1 year, it's down about 50%. So when I see a stock that's actually down in performance like this, and their trend on their stock price is actually down, that's a bit concerning, because at the end of the day, when you see a stock that's actually downwards and they're trending downwards, I would just be a little cautious on that, and maybe I would weigh a little bit less on that, because just based on their overall trend, it's hard to say if the stock's going to actually climb out of what they're doing. Now, additionally, I mean, there's other things that I look at. I do look at the dividend growth of that stock and the dividend consistency of that stock. And a nice actually way and a nice tool that I'll share with you guys is Seeking Alpha. So if I go to Seeking Alpha and I just go ahead and type in one of these stocks, it will actually go ahead and share with me as far as their dividend growth goes. And this is something that I would go ahead and look at, guys, is their dividend growth. Now with CLF, their dividend growth has only been growing for 1 year. And if we look at their dividend growth rate, they're actually down about 18% in the last 5 years. So that to me is a little alarming. And if we look at their dividend growth chart here, we can tell that this stock has been paying out a dividend. But if we look here, 2012, they were paying out a higher dividend. And since then, they reduced their dividends. And if we look here, there's a gap between 2014 and 2019. That means that the stock was actually not paying a dividend for the last 5 years, and they just started paying their dividends again. So that's why the dividend growth is only for the last 1 year. So some of the things that I would go ahead and look at when you're investing in some of these stocks. So just as a heads up, Steve, this is something that I would want to go ahead and evaluate when you're looking at a stock like this. Now, additionally, let's go ahead and jump back into your sectors. And the next sector here is going to be real estate. Now, real estate, as far as the performance goes, the performance is down about 24% in the last 1 year. But looking at the overall 5-year performance, it's down about 2%. Now, in this, you have 6 holdings. But look at this dividend yield. That's an awesome dividend yield, man. Your dividend yield is right around 7.92%. Now, some of these stocks, I can already tell I like these names. Stag Industrial is one of my favorite industrial companies. This is actually a monthly dividend company. Realty Income, hands down, this is a fan favorite. This is one of my favorite realty companies. That's basically a retailer that has plazas. It's a huge landlord that has different plazas, and they have different tenants like Walmart, 7-Elevens. So I do really like this stock. Ltc Properties, I believe, is another monthly dividend stock. And yes, they are actually another monthly dividend stock, as I think about this. And basically, because they focus on senior housing and hospitals and healthcare, I do like this sector. And I do believe senior housing facilities long term are going to grow, because once we're out of this pandemic, I do see that sector growing. Now, additionally, you got Welltowers in here. Welltowers is another, I believe, company that's within the senior housing facilities. So these are both great companies, but maybe I would look at maybe keeping one of these, because then you're diversifying yourself in the senior housing and healthcare sector. But maybe you can go ahead and diversify maybe in cell towers or maybe into data centers. Now, cell towers and data centers is something that I'm not really seeing here, but companies that I do like within cell towers is I do like CCI, or I do like AMT. Now, both of those companies I would go ahead and maybe recommend to check out, because with cell towers, with 5G networks and cell towers growing at this point, those are going to be great stocks that you can maybe diversify yourself in. Now, Brookfield Properties is another good one here, and New Residential Investments is not a bad stock as well. Now, New Residential Investments, I believe, is a company that goes ahead and has residential properties. So not a bad way to go ahead and diversify into the residential sector. Now, next, let's go ahead and jump into consumers. Now, within consumers, looks like you have 7 holdings, and you're getting a dividend yield of 2.79%. Now, within the consumer space, you got a couple different companies here. Some I'm extremely familiar with, and I like what I see so far. You have Coca-Cola, KOF, which I believe is a segment of the Coca-Cola company, but that's just going to be a segment that is diversified into another area. So yeah, just looking at this is going to be a division of Coca-Cola that's diversified within Mexico and Central America. So not as familiar with this company, but dividend yield looks nice here. PE ratio looks a little high here. Usually what I look for is a PE ratio under 20%. So like I said, not as familiar with this, but in general, I do like Coca-Cola. So I see that you got Pepsi and Coke in here. Personally, I have both of these in my portfolio, so I love these. Additionally, you got Kroger's, Stanley Black & Decker, Lowe's, and Logitech. Now, Stanley Black & Decker and Lowe's, personally, I really like these companies. Lowe's I have in my portfolio as well, and Lowe's, I believe, is considered a dividend king as well. Basically, they've been paying out their dividends for the last 50 years, so I do like this as well. And if we just look at the growth on this portfolio and the performance, that's nice, man. That's exactly what I like to see, because you have 20 years that you're still looking to grow this portfolio, and at the same time you're building income. I like to see a positive 1-year performance and a positive 5-year performance. So this is awesome as well. So now just jumping into the next sector here is going to be energy. Now, energy personally is one of those sectors that pays out a higher dividend, but it's one of those sectors that I don't personally invest in so much, because I don't see energy sector growing at the same pace as maybe some of those other sectors. And that could be because I'm a little biased when it comes down to the technology sector, and when it comes down to looking at other options and looking at maybe battery powered cars that are currently taking over some of this energy sector and that are currently taking away some of the gas and oil companies. So now within this portfolio, you have 6 holdings within the sector, and it looks like you do have an ETF in here as well, which is the clean energy ETF, because I'm seeing an expense ratio here. But within this sector, you have 6 stocks that are paying you an average dividend of 10.32%. So again, that's an awesome and that's a really good dividend. Now within the sector, the companies that I'm seeing here is you got Energy Transfer, Pembina Pipeline, MMP, EPD, Invesco, which is PWT, and then you have another ETF here, which is ACES. Now, Invesco is an ETF that I'm pretty familiar with, so I do like their ETFs. Again, I would also maybe look at Vanguard ETFs, and because Vanguard ETFs are considered some of the safest ETFs out there, and Vanguard is one of the largest companies that has some of the lowest expense ratios. Now, as far as some of these stocks, I'm not familiar with MMP, EPD, or ET, but I can tell you Pembina Pipeline is a stock that I personally really like, that I also carry in my portfolio. So your head is in the right direction here, man. You're investing in some of these stocks that are paying out monthly dividends. And Pembina Pipeline is a stock that does pay out a monthly dividends, and they're actually one of the largest pipeline and storage facility companies within Canada that actually supplies a lot of oil and gas to some of the main companies within Canada. So I do personally really like Pembina Pipeline Corporation, and if we just look at them, I believe they do pay out a really solid dividend, which is 7.61%. Now additionally, let's go ahead and look at the healthcare sector. Within the healthcare sector, you do have 6 stocks here as well. Now within the healthcare sector, I can tell you, just looking at this right now, some of these stocks are going to be awesome stocks that I personally like and have in my portfolio. Within the healthcare, you are getting a dividend yield of 3.15%, but just looking at this, man, these are going to be much safer stocks. Medtronic, love this company. Johnson & Johnson, again, love this company. Pfizer, Merck & Co., Abbey, Amgen. Now, out of these 4 of these, I have in my portfolio, which is going to be Merck & Co., Abbey, Johnson & Johnson, and Medtronic. And as far as your target weight, I like this, man. This is a good target weight as far as just looking overall at the strength of some of these companies. Now, personally, if this was my portfolio, I would go ahead and maybe weigh a little bit more on the healthcare sector, because this is a much safer sector that's going to grow and that also has a lot of growth potential. So I do really like the companies that you have invested in the healthcare sector. Now, additionally, technology. Now, technology is something that I've really been focused on as far as growth companies. Now, because you still have a 20-year time frame, I would probably go ahead and increase technology and maybe reduce energy. Now, within the technology sector, if we look at this 1-year performance, you'd be up about 2%. And then if we look at the 5-year performance, look at this. I mean, you'd be up 134% in this. So if you had invested $10,000 within the technology space, you would have 20,000 plus within just your technology sector. So hence, that's why I really like technology, because you can go ahead and build growth and you can go ahead and build dividends. Now, obviously, dividends are going to be a little bit less within the technology sector. So this is something that I would maybe look at increasing right now. And then as you're coming closer to retirement, go ahead and decrease the sector, because you're going to go ahead and focus less on growth. Now, technology, you have some really solid companies in here. One company that I don't see and one company that I personally really love is going to be Apple. Also, another one to look at maybe is going to be Nvidia. Both extremely high growth companies, both companies that are very easy to understand as far as their business model goes, but just something that I would go ahead and just at first glance say to go ahead and maybe consider. But you do have great companies in here, including Corning, Visa, Microsoft, Western Digital Corporation, NetApp, Broadcom, Cisco System. So some of these companies I do have in my portfolio, including Microsoft, Visa, Broadcom, and then Cisco is a company that I have looked at. I've been kind of on the fence with Cisco, but definitely a company that I've been watching. So great stuff, man. This is actually some really good companies that you have within the tech sector. Additionally, let's look at finance. Now, finance is another area that I personally do invest in myself pretty heavily, because I came from the finance world, and within the finance world, a lot of these companies have multiple ways that they go ahead and build their income. So now if you just look at this, your dividend growth in this is 5.71%. And before I jump into the stocks, the performance overall in the last 5 years would be up 19% in regards to these stocks. So some of these stocks include Main Street Capital, another awesome monthly dividend paying stock. I really like this company. This is a business development corporation basically that goes ahead and invests in other companies, and they go ahead and get paid in interest, or they go ahead and get paid in equity in those companies. JP Morgan and Bank of America are the top two banking sector companies within the US. So personally, I like both of those. I have them in my portfolio. T. Rowe Price is another company that I personally really like. Now, T. Rowe Price, I believe, is another company that's considered a dividend king. So they've been growing their dividends for the last 50 years. And Horizon Technologies, I'm honestly not as familiar with them, but Aflac, another one of those stocks that I personally really love, because Aflac is another company that has been growing their dividends consistently. And I just want to pull up Aflac here real quick, because I believe this is another company that's been growing their dividends over the last 25 years. And if we look here, they've actually been growing their dividends for the last 38 years. So this is another dividend aristocrat company. So hey, great stuff with these companies. I do really like these. And now just jumping into the next sector, let's go ahead and look at utilities. Now, utilities are another safe sector, because people at the end of the day do have to pay for their utilities. I love all four of these, man. These are all great stocks. Now, within the utilities, you are getting a 3.66% dividend yield. You have NextEra Energy in here, Dominion Energy, Southern Company, and Duke Energy. Personally, hey, I love all four of these, and I really like your target allocation towards all four of these. NextEra Energy, awesome company. They're actually the industry leader when it comes down to solar and wind energy. So really good stuff, man, in regards to your utility sector. And then lastly, telecom. Now, telecom is another sector that I personally really invest in. Another one of those safer sectors that pays out a higher dividend. Now, with telecom, as I can tell right away, you got this on lock. I mean, telecom, you got three companies in here. I love all three of these companies. Your dividend yield is 6.44%, which is extremely high dividend yield. AT&T, Verizon, hands down the top two companies within the communication sector that are growing at the same time, as well as they're the industry leaders in that sector. CenturyLink is another good company. Now, as far as CenturyLink goes, they are paying out a higher dividend, but I do believe when I looked at their charts, their 5-year trends is down. I mean, this company's down about 70%. So just overall, looking at their performance, I would maybe go ahead and reevaluate this one a little bit, or just weigh a little bit less on their target as far as where CenturyLink is going. So that's just a little bit of my take in regards to that. So overall here, Steve, great job with this portfolio. And again, if this was my portfolio, I would just focus on maybe going ahead and increasing your performance in your portfolio, and taking some of those segments and taking some of those sectors, as far as maybe like the technology sector, as far as maybe the finance sector or the healthcare sector, and increasing the target allocation towards that, and maybe decreasing the industrial sector or the energy sector. Now next, let's go ahead and jump into the next email and the next portfolio here. And this email is gonna be from Jason. Jason says, can you please give me any advice? I'm 22 years old and I just started my portfolio with M1 Finance. I'm just getting used to using this. I bought a couple stocks but need suggestions on what to buy. Please let me know any feedback or what I should focus on. I'm planning to put $100 a month into the portfolio for now, and then we have the link for the portfolio. So thank you, Jason, for going ahead and sending me over your email here. Now it looks like what you're looking at doing is you're looking at putting in $100 a month, so about $1,200 a year. You're 22 years old. Can't really tell when you're looking at retiring as far as your overall strategy, but I'm going to assume that you're probably going to look at retiring around 55. And in regards to your portfolio, let's go ahead and pull that up, and we can go ahead and see what you're allocated in. So just jumping into your portfolio here. Now in regards to your portfolio, you have 6 holdings in here, Jason. So this is definitely interesting, but overall, as I look at this, your performance in this portfolio is up 48%. So that's extremely good performance. And then if we look at the last 5 years, whoa, your performance is up 288%. Now that's extremely good performance. But if I look at the overall dividends in the portfolio, the dividends are 0.85%. Now as far as your strategy, I guess I can't really say if you're focused on dividend strategy or growth strategy. Now to me, it seems like because you're 22 years old, you're probably focused more on growth as opposed to dividends, which is definitely not a bad strategy to focus on. Now if I was 22 at this point, I would go ahead and maybe keep my focus on growth at this point, and as you get closer to retirement, meaning once you're within that 20-year phase of retirement, I would go ahead and maybe change that strategy to dividends. So now just looking at your 6 holdings in this portfolio, you have Google in here, Microsoft, Apple, Amazon, Johnson & Johnson, and Facebook. Hey, I mean, these are going to be some of the largest cap companies in the United States and basically in the world. I mean, these are extremely good companies. I can't see any of these companies going anywhere for the next 30 plus years. Now, personally, what I would say, and I'm not sure how much you have invested in this portfolio overall, but because you're looking at investing $1,200 a year, I would go ahead and maybe look at investing in some additional stocks in here and maybe diversifying in some of the other sectors. Now, if you look at my portfolio, you can tell that I have diversified in the 11 different sectors. And personally, if I look at this, you're basically investing in some of the top companies, but maybe go ahead and look at investing in companies maybe in the real estate sectors that are growing, like a DLR or like a Prologis, which the ticker symbol is PLD. So some of those companies are going to be growth companies as well within real estate. Maybe focus on some of the industry leaders in some of the other sectors, like maybe a Verizon or maybe like an AT&T. So just some other ways to go ahead and diversify. Obviously, if you want to stick with the growth strategy, these are going to be awesome stocks, man. I mean, if you're looking at just growth, some other companies that I would maybe consider is maybe like a Tesla. Another one that I can think of that I've been watching recently is like a Spotify, and also maybe like a company like a Nvidia or like Zoom. Basically, these are companies that are growing at a really extremely high pace at this point. But overall, hey, this is a really good start in regards to a portfolio. I personally really like the performance level of these stocks, and I can tell you just looking at this, I don't see any of these stocks going anywhere anytime soon. But now let's go ahead and jump into the next portfolio here and the next email, which is from Sandy. Sandy says, hi, Hi Andy, I've been watching your channel now for a couple weeks and love your content. I started a portfolio on M1 Finance and my goal is to have this money to live off of the interest and dividends into retirement. I'm currently 40 and planning to retire in 15 to 20 years, hopefully. Any insight or review would be great. Thank you in advance. Hey, thanks Andy for going ahead and sending that email over, and thank you for sharing your portfolio. So let's go ahead and jump into your portfolio here. Now, in regards to your portfolio, a couple things that I'm considering is you are 40 at this point, and at this point I would probably start focusing more on the dividends as opposed to the performance. But let's go ahead and jump into this and see what you got going on here. Now, as far as the performance goes, the performance 1 year is 35%, so that's actually pretty good here. And as far as the 5-year performance, it's 43%, so that doesn't look bad at all. Now, as far as your dividends, that actually seems a little low at 1.77%. So let's go ahead and look at some of your holdings. But what I would personally say, Sandy, at this point is you want to start going ahead and maybe investing more in stocks that are actually going to be paying a higher dividend if you're focused on building that passive income. Now, as far as the expense ratio goes, it is 0.04%. That tells me that you do have some ETFs, and I can just tell based on the slices that you have here is you have a couple ETFs in here as well. So just looking at this, you have 4 different slices. You have a growth ETF slice, you have growth stocks, dividend stocks, and dividend ETFs. So just jumping into your first slice here and looking at the growth ETFs, you have 11 different ETFs which are paying out a dividend yield of 2.28%, and then your expense ratio is 0.05. Now personally, first glance here, I really like what I see because you're invested in a lot of high quality Vanguard funds. Now these are extremely good. Some of my favorite funds are actually in here as well. I do really like VO, which is a Vanguard S&P 500 ETF, which basically follows the S&P 500 index. Also, additionally, you have some diversified funds as far as a fund in the REIT sector, in mid-cap sector, but just in general, running through this, you have VEA, VTC, VTI, VUG, VGO, VO, VB, VNQ, VO, BLV, and VTC. So my personal take on this would be to go ahead and maybe reduce the amount that you're actually investing within this overall growth ETF sector. But let's go ahead and look at your growth stocks here. Now in the growth stocks, you have 6 stocks. And obviously because these are growth stocks, they're not going to be paying out a dividend. And I believe the only one in here that actually even pays out a dividend is Disney, but Disney has cut their dividends at this point. So I'm assuming that this dividend yield is actually going to be going down to 0. But some of these companies you have in here, I love them. You have Tesla, Google, Facebook, Amazon, Disney, Berkshire Hathaway. All of these companies, hands down, are awesome, amazing growth companies. But again, if you're focused on income, I would just reduce that slice. And now jumping into dividend stocks and dividend ETFs. The dividend stocks that you have in here is you have 10 holdings at a dividend yield of 2.61%. And some of these stocks include Microsoft, Apple, Johnson & Johnson, Coca-Cola, JP Morgan Chase, Realty Income. Oh, I like these. These are very good dividend stocks. AT&T, Waste Management, Nexter Energy, 3M. Now personally, hey, my take on this is keep all of these in your portfolio and maybe look at some of the other stocks. I mean, as an example, you can look at some of the stocks that I have in my portfolio to go ahead and maybe add on to this. And just as a personal suggestion, as far as if you want to go ahead and do some homework and look at some stocks that are paying out high dividends, Seeking Alpha is a great site for that, as well as dividends.com. And those are basically 2 places that I go ahead and look and do research on some of the highest quality dividend stocks that maybe you want to go ahead and invest in your portfolio. But hey, I really like every single one of these stocks. I would not cut any of these stocks if it was my personal portfolio, but maybe I would just add additional stocks that pay out a higher dividend. So great stuff with all of those. And dividend ETFs. Now dividend ETFs, you have 5 holdings. You do have an expense ratio, obviously because you're investing in ETFs, of 0.16%. and dividend yield of 3.32%. And as I look at this, I like all of these. Now, ones that I'm not as familiar with would be Schwab and would be VYMI, but SPHD is actually a very popular dividend growth ETF. So personally, as I look at this, I like VYM, VIG, and SPHD a bit more than the other 2, but I guess at the same time, I'm not as familiar with SCHD and VYMI. But if this was my portfolio, I would probably go ahead and weight these a little bit more in my portfolio as opposed to the other ETFs. So overall, this is really good stuff. Now, as far as your ETFs, I wouldn't add anything else in here. I would just maybe change the allocation to weigh a little bit more in regards to some of these portfolios. But if we just look at SPHD, I mean, look at this. This is an amazing dividend yield at 5.69%. So really awesome stuff with this dividend ETF slice. Now, just like I had mentioned, the only thing that I would personally really just look at doing in regards to this is reversing your target allocation and maybe investing a little bit more on the dividend stock and changing that to maybe 30% allocation, and reversing that and maybe changing the dividend ETFs and reversing that with the growth ETF. But hey, overall, I really do like this portfolio. But guys, that's basically going to be a wrap for this video. Now, hopefully you guys like this new series. I personally really like reviewing different portfolios, and basically by doing this and sharing this with you guys, it gives us all a good indicator of some of the other options that are out there. Obviously, if you want to look at my portfolio, go ahead and check out the link down in the description below. And if you want me to go ahead and review your portfolio, go ahead and send me an email. My email will be in the description below, and just send me a quick description of what your goal is basically with that portfolio. And like I said, said, I'm looking to go ahead and keep building on this series and hopefully doing this at least once a month. But thank you again, guys, for watching this video. And if you are new to my channel, make sure to go ahead and hit that subscribe button down below. And if you like this video and you want to see more videos like this, make sure to hit that like notification as well. But thank you again, guys. I will see you at the next one.